We record. Awesome. Well, hi everybody. Happy Thursday. It is Thursday. It's almost about 10:06. Good morning. I hope everybody on this call is doing fantastic. Thank you guys so much for being on this Zoom call, another Zoom call, right? So I appreciate you spending your morning here Thursday with us to learn some new things, hopefully, and to learn about title and to hear me kind of talk about some case stories, examples, and so forth. So for people that I have not had the pleasure of meeting, I do see a lot of familiar names. I see Tom, Jessica, Johnson. I know you were going to sign up yesterday. Joe, see a lot of familiar faces. May, good to see you all, even on Zoom. I hope I can get to see some of you in person soon. But so for those of you that I don't have the pleasure of knowing, my name is Jerry Wu. I'm with Stewart Title. I've been, so quick little introduction. I have been in the title business now for almost about, maybe about 10 years or so, 10, 11 years. I've had the pleasure of working with Tri-County Association of Realtors for many of those years. Laura and her team has been super, super supportive. We've done a lot of events together. They're just a great group of people. So I'm really glad I can be doing this for you here today. Mainly, I service the areas around Southern California, Los Angeles, San Gabriel Valley, Orange County, even San Bernardino, Chino Hills, that sort of area. So if you're from that area, then we probably have seen each other many, many times. So with that said, today I'm going to spend the next about 1 hour, and then we'll leave some time for questions afterwards. We're going to be talking about title insurance. All right. So I'm with Stewart Title, so we're going to be talking about title insurance. Now, because I don't know where everybody's level is in terms of where they are in the business, I'm going to start with, the basics of title insurance. So if you've been in the business for a while, this might be some repeat information for you. So thank you for your patience as we go through that, because we want to make sure that newer agents and so forth do get the basic information and education and knowledge from that as well. We'll then we'll talk a little bit about vesting. For example, what are the different vesting methods, joint tenants, tenants in common, trust, how do all those work? We'll then talk about the prelim, how to actually read a preliminary title report. What are some of the red flags to pay attention to? And along the lines, I'll share with you some case stories and so forth that, that we've gone through as well. So that's going to kind of be our timeline, and that should cap us off at around 1 hour. And then if you have any questions, we'll leave the last 15, 20 minutes or so for questions. All right. So, and if I will leave my contact information, let me do that now, because sometimes I realize some people need to get off the call a little bit earlier. So let me just type in my contact information. So if you do need to get off, you can always call me afterwards. Okay, so I got my contact information in the chat box. If you do have any questions, you're welcome to just unmute yourself, ask the questions, or just type it in the chat box. So let's go ahead and get started. All right. So title insurance. Now, if you're a newer agent, you might not know what exactly is title insurance. A lot of people study it in the exam, but really when you ask them what exactly is title insurance, there's no real good answer for it, okay? And this is especially important. And why I mention this is because title insurance is one of the more expensive fees in a closing, right? So I would always say the top two most expensive fees, excluding your commission, right? Not including the commission, is title and escrow. Now, most sellers and buyers, they know what escrow is. They talk to the escrow officer, they maybe go into the office, so they really don't need that much of an explanation as to what escrow is. But a lot of buyers and sellers do not interact with us, the title company. We're usually interacting with you guys and the escrow agent. So, a $500,000 home title fee could be $1,500, $1,600. It's pretty expensive. So the seller might ask you, oh, hey, Gene, what exactly is this, $1,500, $1,600 charge for title? So I want you guys to feel confident that you can give them a 1-minute response that you feel confident about. So let's go ahead. I'm going to go ahead and start sharing my screen here. All right. So title insurance, and this flyer says title insurance protects you against covered title defects like a previous owner's debt, liens, and other claims of ownership that may have been instituted prior to purchasing your home. What does that mean? All right. It's a little confusing. Honestly, I've been doing this for a while now, and that doesn't even make that much sense to me. If you want a simple answer, title insurance, all it is title insurance insures ownership. That's it. Title insurance insures ownership. Now, you might ask yourself, well, why do I need insurance for ownership? If I buy something, isn't it automatically assumed that it's mine, right? If I go buy a car, it's my car. I get insurance, but the insurance is to insure in case I get into a car accident, not to say that the car is mine, right? If I go to a Target and I buy a TV, it's my TV. There's no question as to whose TV it is, right? I don't need an insurance policy to insure my ownership. Well, that's what makes real estate so unique and so different. We're one of the only industry that has ownership insurance. So really what that explanation is saying that once you buy a property, it could be vacant land, single family, condo, whatever it might be. If you have title insurance, your ownership is insured, and that nobody from the past or no lender from the past, no government entity from the past, and so forth can come back and threaten the ownership of your property. Because imagine how unfair it would be if you bought a property, you lived in it, you moved in, you lived in it, you're all comfortable. All of a sudden, you get a letter from in the mail saying that, hey, we're the lender for the seller, and you know what? We did not get paid when the home was purchased, and you bought it. So since you're the homeowner, pay us, right? That would be very unfair. Or what if somebody knocks on your door and say, hey, I'm the seller's brother, and I actually have 25% interest. I never decided to sell the property to you, right? So that would be extremely unfair to you. So again, that's what title insurance is. It insures ownership. Now this slide talks about how is title insurance different from a traditional insurance policy. I touched on that a little bit, but see, most insurance policies that we all have, right? I'm assuming we all have car insurance. I'm assuming we all have health insurance and whatever other insurance that we all have. Insurance more or less all work the same way, right? You pay, maybe twice a year or once a year or however many often in case something were to happen, right? We all have car insurance. We all have auto insurance, right? We pay maybe twice a year in case you get into an car accident. And then once you get into that car accident, then the insurance company goes and do all the work. So we all know how car insurance works. Now, title insurance works kind of backwards, right? So before we issue the insurance policy, we issue what's called the preliminary title report. And then we do all the work up front before the close of escrow to make sure that title is clear. All right. So once title is clear, then we transfer it to the new owner, right? And then there's only a one-time premium. That's it. One-time premium. And then once issued, that title insurance policy is good for as long as you own the home. So if you own the home for 10 years, great. 40 years, fantastic. All right. It's good for as long as you own the home. Another reason why I always tell clients it's very important that you guys work with a large title company. All right. Now, I understand not every file you get to work with me or my company. Stuart's been around for 125 years and so forth. I get it. It's okay. But I always say, even if you can't work with us, try to at least work with a large company, because what good is an insurance policy if the company is no longer around, right? So we've seen a lot of that during the recession in 08. A lot of the small title companies either got bought out or they went out of business or whatever. So I always say, if you're going to buy a life insurance policy, right, you want to buy a life insurance policy from a large company, not from some small company. So that's what I always promote. That's what I always say. It just seems to make the most sense. Now, in a typical transaction, there are two types of policy that gets issued. All right, let me say that again. In a typical transaction, two types of title insurance policy usually gets issued. One is called the owner's policy. This is what I was talking about earlier. All right. So this is the one that lasts for as long as you own the home and ensures the buyer that, their home is theirs. All right. Here in Southern California, as you guys, many of you may already know, the person who pays for this owner's policy is normally the seller. Even though the policy is for the buyer, right? It's for the buyer. Typically in Southern California, the seller is the one that's paying for it. Of course, everything is negotiable. Maybe if it was a great deal, then you might say, hey, buyer, you pay for everything, right? Or sometimes when new homes are super hot, the builder will say, hey, buyer, you pay for everything. So it's not set in stone, but typically speaking, the seller pays for the owner's policy to insure the buyer. And this is good for as long as you own the home. Now, the loan policy, this one is to insure the buyer's lender, right? So if you're representing a buyer and they're going to say Wells Fargo or wherever it is that they're going, Bank of America or a broker, to get a loan, that lender is going to require a title policy for their loan, right? It's called a loan policy. And this one is typically paid for by the buyer, right? The buyer is usually the one that pays for this. And it's only good for the term of the loan. So our owner's policy is good for as long as you own the property, but this loan policy is only good for that particular loan. That is why every time that there is a refinance, there is a new title charge when you do a refinance, because when you do a refinance, they have to issue a new loan policy, even if it's with the same lender. All right, even if it's with the same lender. Now, you might be thinking to yourself, why does the lender need a title insurance policy? All right. So think of it like this. The lender wants a title insurance policy because they want to make sure that, hey, if I'm going to lend you, $500,000, $600,000, $700,000, however much it is, I want to make sure that one, you are who you say you are. Because what if it's fraud, right? What if you're not the person that you say you are and we just lent money to the wrong person? So we want to have some insurance. Two, we want to make sure that you don't owe money to anybody else that we don't know about, right? So imagine if your friend comes up to you and say, hey, hey, Jessica, can I borrow, $1,000? Jessica might say, okay, all right. But what if Jessica found out that this person also owes a lot more money to a lot more other people? So all of a sudden, Jessica may say, I don't know. I don't know if I want to lend that person $1,000 anymore, because if I do, more than likely all those other people will get paid before me, right? So that's called the positioning of the loan, right? In real estate, your loan could be in first position, second position, and that positioning is extremely important, because if any of the loans were to be foreclosed, the senior loan always has some priority. For example, let's say there's two loans that are taken out on the property. There's a first and then there's a second, right? Now, if, for example, the first loan gets foreclosed on, right? So say the borrower cannot make payments on it anymore. And then on the first loan, then the first loan gets foreclosed on. Guess what happens to that second loan? It just gets wiped out. It gets forgiven. Any extra money goes towards, extra money left from the foreclosure might go to pay off that second, but essentially it just kind of disappears, right? So that priority is very important. So a lender wants to make sure that, hey, if I'm going to be in first position, I want to make sure that there's nobody else that the buyer owes money to that we don't know about. So extremely important. So that's why they have a loan policy. Now, speaking of loan policy, I want to tell you guys a little story about a fraud. I've told this story before. Some of you guys may have heard this, but it's a story about fraud on a loan policy. So not a couple of years, I don't even know how long ago this was, maybe like 2000 sometime, early 2000 or something. There was a big loan fraud that happened to the previous company that I was with. Essentially, there was this $8 million home out somewhere in Los Angeles County, and the homeowner, I guess, spends portion of the time here in the US and a portion of the time in another country and so forth. And it was a house worth $8 million that had no loans. It was free and clear, right? And then, so these group of people that we later think they were maybe like, organized crime or whoever they were, created fake identities pretending to be the homeowners, right? So once they created these fake identities, what they did was they opened a bank account under the homeowner's name, right? So they were pretending to be the homeowners to open a bank account, and then they deposited $1 million of their own money into this bank account. And then they started making withdrawals and deposits. So there's a history. Long story short, they went to a lender not long after, and they said, hey, lender, we want to do a cash out refi. We want to pull out $4 million on our $8 million free and clear home. Remember, they don't own the home. They're not the real owners, but on paper, it looks like they are. So they went, the lender said, okay, they did all this, everything that they needed to do, and they pulled out $4 million from this $8 million home. And of course, once they got that $4 million, they were gone, right? The homeowner came back home one day from wherever it is that they were traveling to, and they got something in the mail saying that you now have a lien on your property for $4 million. They're like, we did not get a loan for $4 million. What is this all about? So of course they, called around and then went back to the title company. The title company started doing research and then basically uncovered this whole scheme. Basically, these people that got this loan were complete fraud, right? They forged the signatures, they forged everything. The title company went back to talk to the lender. The lender was like, "Oh yeah, I know those homeowners, right? They were so nice. We went to dinner with them, and I met their kids. Complete everything was a fake, right? So these criminals, they spent $1 million of their own money, and then basically was able to do a $4 million cash out refi on a house that did not belong to them. And guess what? Because there was a loan policy issued to the lender, right? The title company paid the lender $4 million. So, so that was a pretty big payout. Pretty big payout. So how long does the policy last? I talked about that already. Loan policy lasts for the life of that loan. Owner's policy lasts as long as you own the property. Now, this is a little kind of there is a caveat to this, all right? I said, as long as you own the property, your owner's policy is good for as long as you own the property. All right? So what do we see a lot of here in SoCal? We see title being transferred back and forth between a lot of different people. So if I bought the property, I have an owner's policy. But if I were to transfer that property to my mom, let's say, right? So I said, hey, mom, I'm just going to transfer title to you, which is completely legal. Then there is no more title insurance, all right? There is no more title insurance for my mom. My mom does not have title insurance. Same thing if I were to transfer it to my own LLC, right? If I were to transfer it to my own LLC, keep in mind, an LLC is a separate legal entity. And if I transfer it to my LLC, the LLC does not have title insurance anymore because the title company insured me as an individual, not my LLC. So what do you want to do in a situation like this? If you are transferring title to your own LLC, what you want to do is go back to the original title company that insured you and say, title company, hey, I'm going to do this transfer. And it's to my own LLC, not to other people. It's my own LLC. And then the title company will issue you what's called an endorsement. And usually for about like $100, all right? So Gabriella asked, what about a quitclaim deed? Would that affect owner's policy? Yes, a quitclaim deed, Gabrielle, is just an instrument to transfer title. Grant deed, quitclaim deed, all it is like an instrument, like a tool to transfer title. So if I use the quitclaim deed to transfer title to my mom, no different than using a grant deed to transfer title to my mom, all right? Or to transfer to an LLC. So back to what I was saying, if you transfer title to your own LLC, make sure you go back to the original title company and say, hey, title company, can you issue me an endorsement? It's usually about $100 So the LLC will continue to have coverage. All right. Now, why is that important? You may not think it's important, but I will give you a story where it did affect somebody. It wasn't one case I worked on, but one of my lender clients told me about this. Essentially, he had a customer that purchased a property in LA County, right? Now, the seller of this particular property had a loan. However, that lien for the loan, for whatever reason, we don't know why, accidentally got recorded in the wrong county when the seller took out that loan. Okay, so when the seller took out that loan, they should have recorded the lien in LA County because that's where the property was, but then they recorded it in like San Bernardino or wherever county it was. So anyway, the title company did not find that particular lien because they were searching LA County, right? And the seller wasn't that great of a person. He thought, well, if they don't find it, I'm not going to say anything, right? Because guess what? He's going to be able to net more money. So that's exactly what happened. He did not say anything. The buyer purchased the home, right? Closed escrow, purchased the home. And then within about a week or two, he transferred the home from his personal name to his LLC without getting an endorsement from the title company, whichever title company it was that insured him. I think maybe about a month later, remember, now the title is under the buyer's LLC. About a month later, he gets a letter in the mail saying that, hey, we are the lender. We lent X amount of money to, to this property. And, we didn't get our money. So the buyer's like, what the heck? It's none of my business. Good thing I have title insurance, right? So he files a claim with that title company, and then that title company denied his claim. And the reason they denied his claim is because they're like, hey, we insured you. We didn't insure your LLC, and title is under your LLC, right? And you didn't get that endorsement. So that particular title company actually denied his claim. Now, he ended up going to get an attorney to fight this, but another example of getting the importance of getting that endorsement. Now, I will say, statistically speaking, most title claims happen within the first couple of years of purchasing the property. The longer you own a property, the less chance that there will be a claim. Not impossible, but just not as common. So just kind of keep that in mind. Now, how much does title insurance cost? Now, we are insurance. Keep that in mind. We are insurance. So like all insurance product, it's based on the coverage amount. So the more expensive the home is, the more expensive title insurance is. The more expensive your loan is, the more loan amount, the more expensive your loan policy is. All right. Now, most common title claims, it could be anything. Title claims, we get a lot of small claims, maybe just like a typo, maybe escrow made a mistake, on the legal description, they wrote lot 2 instead of lot 5. It's small little things. Maybe the name got misspelled or wrong. Those are very easy to correct. The big claims are usually involving fraud. And believe it or not, like title companies, I feel like personally, we exist really just to prevent fraud, right? And to make sure everything is disclosed correctly. I don't want to say the only reason we exist is because of fraud, but I feel like nowadays with so much fraud happening, that's one of the main jobs that we do is to prevent fraud. And I'll talk a little bit more about fraud as we move on. All right, so let's, any questions before I move on to the next topic? I hope I didn't lose anybody yet. All right. Well, let's talk a little bit about vesting then. So we're going to move on to our next topic, and we're going to talk about the different ways to hold title. All right. So let me stop sharing for a second and let's just talk. So when we talk about vesting, we're talking about estate planning. All right. Estate planning. And what is estate planning? Estate planning is really just what happens to my stuff after I die. Really, that's all it is, right? What happens to all my assets, my house, my bank account, all these things? What happens to my stuff once I die? That's estate planning. And the way that you choose title, the way that you hold title has a direct impact on that. The reason why I'm talking about this is because this is a legal issue, right? This is estate planning. So we want to make sure that us as real estate professionals, we do not tell our clients how to hold title. We do not tell them they should choose joint tenants or community property and so forth. However, you do have a responsibility to your clients. So it's good to educate them on the main differences and then allow them to choose. Okay, so that's that's the approach that I always tell, because a lot of buyers will always say like, hey, Jessica, which one should I choose? And since sometimes agents will just choose for them, right? Don't do that. So just kind of educate them. We have flyers. The flyer that I have, I can email to you guys afterwards. So let's talk about first how one person on title holds vesting. All right, just one person on title. If there's only one person on title, there's 3 ways to hold vesting, hold title. All right, 3 different ways. There is called a single, or we'll just use a man for our example. Let's say the buyer is a man. So we'll be a single man, a unmarried man, and then a married man. Okay, so it'll be, for example, John Doe, a single man, John Doe, an unmarried man, or John Doe, a married man as his sole and separate property. So for one person to be on title, there are those 3 ways. Now let's talk a little bit about them. Why we want to specify that is because if he is the only person on title and John Doe were to die, he were to pass away, that property has to go through probate. It has to go to a court, a probate court, and then a probate judge will determine how that property should be handled once John passes away. Does not matter if he is a single man, an unmarried man, or a married man. So even if John is a married man, he's on title by himself. If he dies, the property is going to probate. Okay, let me repeat that. Even if John is a married man, if he's on title by himself and he dies, the property is going into probate. Now, through the probate process, maybe his spouse will get the property, but we don't know. That's not our job as real estate professionals to make that decision. So a single man, an unmarried man. Now, what is an unmarried man? An unmarried man is just somebody who was once married and is no longer married. So to help you remember, the joke I always tell is once you are single, you are never married again. All right, so that's an unmarried man. And a married man is a married man. So as you know, here in California, for a married man to be on title, his spouse will have to sign a quitclaim deed, right? So if Joe Lamb, he's a married man, decides to buy property himself, and he wants to be on title by himself, his spouse will need to sign the quitclaim deed during escrow to give up her interest to the property. However, people ask me, Jerry, what if the spouse cannot sign the quitclaim deed, right? So Joe wants to be on title by himself as a married man, but his spouse cannot sign the quitclaim deed. Is this possible? Is this possible? And the answer is yes, it is possible, but only in a situation where you have like an all cash buyer, right? There's no loan, or maybe it's like a hard money private lender and they don't care, right? So only in those situations. However, if Joe, after he purchases, if he wants to go get a loan, or if he wants to sell that property later, the title company will see that his spouse never signed a quitclaim deed, and then at that point, they will ask for the quitclaim deed from the spouse. So sooner or later, the spouse will need to sign the quitclaim deed, but if you were to purchase all cash, it gives you a little bit of flexibility as to when that happens. All right. Any questions on that? If you guys have any questions, feel free to unmute yourself. I think we only have about 20 people on here, so it's not too many. So feel free to unmute and ask any questions that you have. All right. So when you have now, that was for one person, okay? When you have more than one person, you have to choose amongst these options that we've all seen before: tenants in common, joint tenants, community property, and community property right of survivorship. So for the sake of simplicity, I'm going to give you the main differences, and this is my recommendation on how you may be able to explain it to your clients as well. If your buyer says, hey, Jessica, I'm buying a property, A and B, I want to have, 70%, and he will have 30%. If that were the case, the only option to choose from is tenants in common. This is the only option that allows for separate interest, okay? Only option to have separate interest. But there is no right of survivorship benefit. So that means if A dies, right, that 70% that A has will have to go to probate. So if you were to take a listing and somebody were to tell you, hey, Janie, the one of the other owners had passed away, first thing you got to do once you get out of that appointment is call me so we can check to see how they held title. Because if it's tenants in common, we might be in a probate situation. All right. Next option is joint tenants. Joint tenants is almost a complete opposite. All right. Everybody has to be on title as equals, as a whole. So, if 3 people on title, then they each have 1/3 interest. Everybody owns title together as a whole. And anybody can be joint tenants, husband and wife, friends, parents, brothers, sisters, doesn't matter. But everybody has to be on title as a whole, as equals. And there is an automatic right of survivorship benefit. So if one person passes away, the property goes to the surviving joint tenants. That's it. No probate. No probate. So that's what's so good about joint tenants. So if you take a listing and then the same thing, seller tells you, hey, one of the owners has passed away, we check. And if they're joint tenants, you're good to go. The only thing you would need to ask for is an actual death certificate for the deceased, for the person that passed away, and then we'll take care of the rest from there. The next option is community property and community property right of survivorship. Now, they are super, super similar. So for the sake of time, I'm just going to be talking about community property right of survivorship. All right, but they're very, very almost identical. Now, community property right of survivorship is very similar to joint tenants, except that it's only reserved for spouses, only married couples or registered domestic partners. Okay, and there's also an automatic right of survivorship benefit. There's also an automatic right of survivorship benefit. So that means, a married couple can hold title as community property right of survivorship. And if, say, the husband were to die, then the wife would be able to sell the property, no probate. She would just need to provide a copy of his death certificate. So then now you might ask yourself, well, that sounds very similar to joint tenants. Why would, a married couple choose community property right of survivorship over joint tenant? Or why would they choose one over the other, right? Because that sounds very similar. And a lot of people choose, husband and wife choose joint tenants, So I will tell you this, guys. The reason why I see more and more spouses choosing community property right of survivorship is because there's an automatic right of survivorship benefit, but 2, there's a better capital gains tax advantage if one of the spouses were to pass away. And that's what I'm going to be talking about, step up tax basis, okay? So this has to do with capital. Again, I'm not a CPA, I'm not a tax professional. I'm just going to educate and tell you guys a tax concept called step up tax base that relates to community property right of survivorship right now. So let's talk about this a little bit. Step up tax base. And again, with step up tax base, we're talking about capital gains tax, not property taxes, not gift taxes, capital gains tax. And what is capital gains tax? It's really just a tax that I would get taxed on if I were to make money on something, right? So let's just say in the year 2000, I buy a property for, I don't know, 500,000, right? So that's my base. If today that same property is worth $1 million, how great would that be, right? Fair market value, all right? Fair market value. And then before I continue, let's simplify our example, okay? I know single people have 250,000 exemption, 500 for married, depreciation, there's all these different factors. Let's just forget about all that for a second, okay? Let's just simplify our example. So no 250, no 500, just simplify. So let's just say you buy a property in the year 2000 for 500,000, and then you sell it today for $1 million, right? That's a fair market value. You're gonna make $500,000, right? You just made $500,000. So the IRS is gonna say, hey, you have a capital gains of 500,000. You need to pay us taxes based on 500,000, right? That's very common. Well, this is how step-up tax base works. Let's rerun our example. Let's pretend today, John and Jane, the married couple, buys a property for 500, or in the year 2000, I'm sorry. In the year 2000, John and Jane, married couple, purchases a property for 500,000 and holds title as community property of right of survivorship. Now, today, that property is worth $1 million. And then all of a sudden, John, the husband, goes out. He maybe goes to the grocery store. He hits a tree and he dies, right? He dies. Well, what ends up happening is that old base value will step up to the fair market value on the day he dies. Let me repeat that. The base value will step up to the fair market value on the day that he dies. What that means is if he dies today, our base becomes $1 million. All right. So the new base is now $1 million. So that means if the wife, she's very sad, she doesn't, she wants to sell the house, she doesn't want to live in it. She puts it on the market. She hires, maybe Janie to sell the house. Janie puts it in escrow, and guess what? She gets an offer for $1 million, right? Because that's the fair market value of the house. Well, the base value is now $1 million, and then she sells it for $1 million. So there's zero gains, zero capital gains. So that's step up, and that's how it works. And that's one of the benefits with community property, with right of survivorship, and even community property has that same benefit. So you do get somewhat of a similar benefit with joint tenants, all right, but you just don't get that full step up. Maybe you can only get a portion. Now, one of the other ways that you can hold title is also through a trust. A trust is so let's move on from that. A trust is another great way of holding title, okay? Because also a trust prevents any type of probate. Generally speaking, there will be no probate, all right? Because you've already planned out everything. Now, with the trust, if you guys take a listing and the seller is a trust, the person that you should be working with is the trustee. All right. In every trust, there's a trustor, the trustee, and the beneficiary. The person that you need to have to sign all your paperwork and contract, it's going to be the trustee of that trust. So make sure you verify who is the trustee. If you have questions as to who is the trustee of that trust, you call us and we will verify. We may request a copy of the trust. We may not need it, but always you want to verify that, especially if, say, for example, the original trustee died, right? And then maybe the successor trustee is selling the home. We need to make sure that that person that you are working with has the right to sign for that house, for that trust. Another thing that you want to really pay attention to with the trust is you want to make sure that even for you, right? Even for the people listening on this call, if you have a trust, you want to make sure that the title of your house is changed to a trust. All right. So it's not enough that you just go to an attorney and create a trust. You have to change the title of your home to the trust. I'll give you the perfect example, unfortunate example. We closed the file earlier this year in the city of Walnut. All right. Now, it got into escrow really fast. We opened the title order, and then we found out the agent said, "Hey, Jerry, I'm just putting this property into escrow. You're going to work on the title, of course. And the property is under trust. And then the mother already died. The son is the successor trustee." And we're like, okay, cool. The son is the successor trustee. That's the person you're working with. Great. So they go into escrow. They open title. Well, we open title, I'm sorry. And then we look at the title report, and I called the agent and I said, "Hey, you know what? Title's still under the mom's name as an individual. It's not under the trust." And then they're like, "No, the son said that they have a trust." I said, "Yeah, but they never put the title under the trust, and the mom's already passed away, right?" So they sent us a bunch of documents, and it looks like she really did create a trust. She just never changed the title of the home into the trust. Long story short, they still needed to go to probate. So it was just unfortunate because the whole point of doing this is to avoid probate. They still ended up needing to go to probate. And then the court then issued a court order stating that the property is to be a trust. And of course, now the son is the successor trustee. in which case they could sell the house. So what was supposed to have closed in probably, I think it was a short, 2-3 week escrow, ended up being like 4 to 6 months. I think 4 months, something like that. So just keep that in mind. So that is the portion on vesting. Any questions before I move on, guys?
Hey, Jerry.
Hi.
Hi,
Jessica.
Thank you for have a Zoom meeting to explain this. So how, instead of you say the individual title, how to suggest the client to go to the trust?
So when you create the trust, right? Let's say, Jessica, I don't know if you have a trust or not, but let's just say you don't. So if you wanted to create a trust, you would go, most likely you might go to an attorney, and the attorney will create your trust documents for you. She'll say like, okay, Jessica, what assets do you have? Do you have houses? Do you have bank accounts, retirement? What do you want to happen to all these things one day when you're no longer around, right? One day when you pass away, what do you want? How do you want all these things to be handled? Who gets what? And who will take care of all these things for you? Okay, so then you'll, of course, work with the attorney. You'll talk about all this. And then she'll put a big document together, and that'll be your trust. And then maybe the name of the trust will be the Jessica Yang Family Trust. Okay, that'll be the name of the trust. So then the next thing that has to happen is there has to be a quitclaim or grant deed created transferring from Jessica Yang as an individual to the Yang Family Trust. And then Jessica will sign that grant deed in front of a notary and then get it recorded by the county recorder office. Most attorney office will do this for you when they do the trust, but I've noticed and I found that some attorney office don't do this. They just create the trust and then that's it, and then the home title never gets transferred to the trust. So maybe that's the difference between hiring somebody for 3,000-4,000 versus doing it for like $800 on LegalZoom. So
do you have any referral for those kind of attorney?
Yeah, I do. You know what? I'll give you the name of the attorney that did my trust. So I'll
Okay,
type it in the
for
chat
the,
box. You can just Google her, just Yvonne Shu Law. You can just look her up, Yvonne Shu. She's in Irvine, California.
okay.
And she did my trust, and I think she's really nice. She speaks Chinese and English and Japanese. So, they're
Wow.
trilingual office.
Thank
So,
you so much.
yeah, and you can just look her up on Google, Yvonne Shu Law in Irvine. All right.
Okay.
Any other questions before we move on? Okay, cool. Let's talk a little bit about the preliminary title report and some red flags, and then we're going to wrap up our session today. Okay. All right, let me share my screen. So I know this is all too much text. 1 second. So the preliminary title report, usually I recommend to my clients, hey, order the prelim as soon as you get the listing. But of course, you're also going to need it when you're in escrow. But if you can, order as soon as you get the listing. That way I can review it for you. I can tell you if there's any red flags. But if you were going to look at the prelim yourself, how would you read the prelim? What are the things that you're going to be paying attention to? So again, this isn't about knowing how to understand everything about the preliminary title report, but I just want you guys to have an idea of what to look out for and how it works, basically. So the cover page of the prelim, every kind of title company is the same format, okay? So you'll have an order number, and then you'll have, the seller buyer name, the property address, and the date. All right, the date is important because that means the title prelim is only current up to this date, meaning if a lien on this property got recorded after this date, it will not show on this prelim. For example, we're working on a file right now where we have the prelim, the agent tells me, hey, you know what? I think there's a judgment. The seller told me there's a judgment from the solar company. I don't know if Annie's on this call, but if she is, she would be nodding her head. But she told me there's a judgment from the solar company and it's not showing on the prelim. And that's because it's not recorded yet, or maybe it was just recorded recently and then the date of the prelim is dated, before that. So this date is very important. Now, moving on, the prelim will always say what type of policy we are issuing. This goes back to the beginning of our conversation, right? So in this one, they're issuing a homeowner policy, an owner's policy, right? And then a loan policy, right? Just exactly like what we talked about. And then beneath that, Schedule A is who is the owner on title and what type of property is it? So it's the owner on title is this Robert Johnson, a married man, as his own separate property. And then the type of property is called a fee simple. Okay. And then the legal description. So the legal description is extremely important. You don't have to understand everything, but you want to make sure at least the APN is right, and then the lot number is correct. Okay, because if sometimes I've seen examples where they open escrow for maybe 3 separate APNs, but for whatever reason, maybe it wasn't communicated right to escrow or to title. We only got information for one APN. And so we only did the prelim. We're only doing a transaction for one parcel instead of 3. So we always want to make sure that the legal description is correct, because this is what we are insuring, not the address. Not the address, okay? The title companies don't insure the address. We insure this legal description. So legal description is a written description of where the property is located. All right. Now let's move on. So that's Schedule A. Now Schedule B is basically all the exceptions. All right. Now the term exception, all that means is that the title company is saying that, hey, we are ensuring that title is clear except these things. All right. That's what exception means. We're ensuring that title is clear except these things. So some exceptions, now here's an easy way to read through these. Some exceptions will continue to stay on title. Some exceptions will have to be cleared. Now, to overgeneralize, the exceptions that have to do with the property generally will continue to stay on title. And then the exceptions that have to do with the homeowner will have to be cleared. Okay, so as you go through this, you want to keep that in mind. For example, if it's an easement, well, this is an easement, it looks like, from 1965. I mean, most likely it has to do with the property. So these will continue to stay. CC&Rs has to do with the property, right? So they will continue to stay, usually speaking, okay? Oops, I'm sorry. But let's look at number 3. This is a deed of trust. A deed of trust is a loan, right? So this has to do with the seller. So this will have to be paid and resolved in escrow. Number 4, a notice of federal tax lien against Robert Johnson. Well, guess what? That has to do with our seller. That has to be taken care of, right? Number 5, matters which may be inspected by a survey and so forth. You're like, then, there is a reason why that's there. But to simplify, doesn't really have to do with the seller. So generally, we don't have to worry about that. Number 6 is saying a statement of information. And that's where we say, hey, we need, in this example, Jane Smith to sign what's called a statement of information. All right. Now, what exactly is a statement of information? A statement of information is a form that asks for a lot of personal information, like your name, your AKA, date of birth, social security number, where have you worked, where have you lived, and so forth. The reason why title companies, we ask for this statement of information is because some liens are not immediately available to search on title. Some liens, maybe like a federal IRS lien, is attached to the person, not to the title, because maybe this homeowner has like a bunch of different properties. The IRS doesn't know how many property you have, right? They're just going to know, hey, if you sell something, you better pay us, right? So we have to use that statement of information, the information on there, to make sure there's no additional liens. The red flag, the issue that occurs is when the seller returns the statement of information back to us too late. So there are times when we don't get the statement of information back until like 3 days or 2 days before the close of escrow, right? And then of course we run it, and then guess what? We find a judgment. And then all of a sudden now everybody's upset because they're pointing fingers saying like, How come this is, we just found out about this last minute? Shouldn't somebody have known about this? Well, guess what? If we only get the statement of information back, 2, 3 days before, then that's kind of how it is. So as you know, some of you have worked with me before, but I read through every single prelim that my client uses me for title on. I read it for you. I send you an email with my overview, and I will tell you, hey, have them complete this statement of information. And the agents that have worked for me for a long time, they develop the habit where as soon as they sign that listing, they get the statement of information filled out by the sellers, and then they return it to me early. So we avoid any last minute surprises. Another reason why a statement of information is important, because sometimes we need to verify whose lien, if there's like a judgment, does that judgment or lien belong to our seller, right? Because people have very similar names, right? So let's say there is 3 Jerry Woos, and this Jerry Woo is selling the house, but there's another Jerry Woo that has a judgment. Well, the title company, how do we know the person that's selling the house? How do we know if that judgment belongs to the person selling the house or just to another Jerry Woo, another person that has the same name, right? So, or a similar name, right? So that's another reason why we need to get the statement of information, because with the information on there, we can clear title to make sure that, hey, if this lien or judgment does not belong to our seller, then we can remove that from title. We see that from time to time. I'm doing one file just right now, right, where there's a judgment against somebody named Ben, B-E-N, Ben, right? But then our seller is named B-I-N, right? But then the guy named Ben also uses B-I-N. So we don't know, like, well, is that our seller? Is that not our seller, right? So we need to make sure we get the statement of information. And I always recommend to get it early as we can. So that's the statement of information. Let me go back and talk a little bit about this deed of trust for a second, okay? Because this is actually very important, a deed of trust. Now, if you guys have been doing this for a little while, you know what a deed of trust is, okay? A deed of trust is a lien that's recorded on title when a homeowner gets a mortgage. It's a mortgage lien, right? If you go to Wells Fargo, if you go to wherever, you get a loan, the lender is going to put a lien on your house. And the way they put a lien on your house is by recording this document called a deed of trust, all right? So now this property has a deed of trust. That means our trustor, which is our borrower, took out a loan in 2016 for $612,000. And then the beneficiary is the lender. Okay, so in this case, it's Onyx Lending. And then they recorded this in 2016. Now, once that loan has been paid off, it's been paid in full, the lender or the trustee for the lender will record another document called a full reconveyance. Okay, reconveyance. If they record that on title and title company, we see a reconveyance and then we see a deed of trust that's, tied together, then we know, okay, this loan's been paid off. However, what if the lender forgets to record the reconveyance? It happens more than you think. I'm working on a file right now where a homeowner took out a loan for a line of credit, the line of credit back in like 2004 or something like that. And then he closed out that line of credit, but then the lender never recorded the reconveyance. He's trying to sell the property now, but guess what? That deed of trust is still showing open on title. So of course he calls the lender, and of course that lender is out of business. It's gone, right? And then so we're trying other ways. We've done other ways to kind of clear this, but always make sure if you close out a loan, make sure the lender records a reconveyance and you keep all your particular documents. All right, because again, if that lender is out of business, it's going to be very difficult. And we see this a lot, especially with private lenders, right? Because private lenders, they're not usually as experienced. So a loan gets paid off and then the borrower and the lender shakes hands and then they think that's it. And then 20 years go by and then this loan is still actually on title. And then now they try to go back to this private lender. Maybe it's their friend's friend and they can't find them anymore. And title, we don't have evidence that it got paid off because it's still showing. And imagine if you were the buyer, right? And then you're like, well, I don't know if I want to buy this property if they can't get a reconveyance. So something to keep that in mind. Continuing on the topic of a reconveyance, if you have ever seen a reconveyance before, it is literally the most simple document. It's one page, signed usually by the, trustee for the lender, notarized, and then recorded. Because it's such a simple document, there was actually a lot of fraud on reconveyances. Um, Reconveyances in the past, right? So somebody would just go and create a fake reconveyance and they would record it. So this one guy did that in the 90s. He would basically take out a loan and then he would forge the reconveyance and then he would then record it. Now his home looks like it's free and clear. What he did next was he just went out and got another loan. And then he reconveyed that loan fraudulently. And then he went out and got another loan. He just continued to do this multiple times until eventually he got caught. Okay. So the title company now, all title companies, okay, this is everything I'm talking about is applies to all title companies, not just Stewart Title. So just keep that in mind. But what that so now the title companies, anytime that we see a reconveyance, where a loan was paid off not through a refi or not through a sale. Because if it was paid off through a refi or a sale, that makes sense. But let's just say somebody took out a loan and maybe like 3-4 years later, they paid it off. And then, they have some extra money, they paid it off. And then and then the lender recorded reconveyance. If we see that when the property goes to sale, we're going to ask the seller to provide some additional proof of payment. Okay, we're going to say, hey, seller, I saw that you paid off your mortgage maybe about 3 years ago. Doesn't look like you did it through a refi or anything. Do you have any additional proof of payment that you paid off this? Okay, in addition to the reconveyance, do you have anything else? Okay, so title companies will ask this from your sellers. So a great piece of advice that you may want to talk with your sellers about or maybe do a video on is to make sure that you educate them that, hey, when you pay off a loan, make sure they keep all the records, okay? The lender might send them a congratulations letter. Thank you for your business. Keep all of that, okay? Because believe me, it will come in handy. And then also remind them, do a video about this also. Hey, if you pay off a loan, make sure in addition to getting those thank you, congratulations letter and all those things, make sure the lender records a reconveyance, okay? It's called a reconveyance. It's a recordable document. Make sure that happens. So again, I'm giving you guys some ideas for video topics to do to educate your clients. We deal with this stuff every day. So believe me, it's not a rare thing. Let me go to the question box real quick. Diana, she asked, can we change title holding at any time? And the answer is yes. You're welcome, Joe. And the answer is yes. So let's say you purchase a property and using joint tenants, maybe between husband and wife, and now you want to change it to community property or right of survivorship. All you would need to do is record another deed, right? Where you deed the property from you to you. So, all right. So it's going to go from like Jerry and Jesse, husband and wife as, joint tenants, deed to Jerry and Jesse, husband and wife as community property or right of survivorship. And then that gets recorded and that's it. All right, let me go back to my prelim here. And we're almost done. We're almost done. Thank you for your patience. Let's see. Oh, actually, I don't need to share. I'm just going to talk about this one last thing. Sometimes when you look at the title vesting, it's going to say something like the owner information. It's going to say something like, maybe like Joe Smith, titles vested under Joe Smith, a single man, subject to item whatever, subject to item something, 5, subject to item 6. So that's where you need to go to that item on the prelim in Exhibit B, Schedule B, see what it says. 90% of the time, it will be due to an uninsured transfer. Okay, now what is an uninsured transfer? This is a very, very, very common thing. An uninsured transfer is a transfer of title that was not insured by a title company. So let's just say today, Jessica buys a property, right? Maybe a year or so later, Jessica is leaving. She's going back to, Taiwan or wherever she's going. She's saying like, you know what, Jerry, you put on a really good class a year ago. I'm just going to deed my property over to you. You can have it. All right. So she signs a grant deed in front of a notary from her name to my name. And then It gets recorded in the county recorder. It's done. And it's perfectly legal, all right? But there's no title insurance, no escrow, no title insurance. It's just a transfer. So now I own the property. If I go to sell this property, the title company will see that, hey, Jerry, I see you're selling this property. And you know what? Jessica is sending me a message, but I hope you can, if you want to give me a property, I'm not going to say no. I'm just kidding. But let's say, okay, so if I go sell this property, the title company is going to see like, hey, I see that, there was an uninsured transfer to you, Jerry, from Jessica. Well, we need Jessica to sign an affidavit stating that the validity of that uninsured transfer. Okay, so we need Jessica to sign that. And the reason, guys, why title company ask for this is, again, fraud prevention. Because the title company, how do we know that it was a valid transfer? How do we know that Jerry did not forge Jessica's signature? How do we know that Jessica, maybe it was not manipulated, right? Maybe Jessica had no idea what she was signing. How do we know that, maybe there's money owed between the two of them, then that the property can't be sold directly without her getting money? We don't know any of these things. We just see that there was a transfer done. It could be fake, could be real, could be manipulation. And guess what? It's happened time and time again. A lot of fraud has happened this way, because think about how easy it is to commit real estate fraud. As long as you can stamp a notary seal on something, you can basically record anything, right? So we need to make sure that it's a legitimate transfer. So anytime that you or your clients are doing an uninsured transfer, make sure you advise them that, hey, there's a good chance that when the property gets refied or sold in the future, that party A, the person who made the uninsured transfer, may be asked to sign an affidavit at that time, okay? So make sure you mentally prep your clients for that. All right, it's about 11:10, so my time is just about up. I want to leave a little bit of space for questions. Do you guys have any questions on anything that I talked about today? Feel free to unmute yourself or type it in the chat box. Well, okay, so if there are no questions, I did leave my contact information. I'm going to type it in again. And somebody's asking if this will be recorded. And the answer is, I believe that Tri-Counties has recorded this meeting. So once it's uploaded, usually you can go on the Tri-County website and then just download it or view it. So I hope this was helpful, guys. I hope that you learned something new. If you're a new agent, I hope this was informative. If you're an experienced agent, I hope I was able to share something new with you guys that you didn't know before. Again, my name is Jerry. I hope to have the chance to work with you guys on the next transaction that you are working on. You can always reach out to me directly. We also have a great tool called Stewart Now. If you need a program to get your property profiles, recorded documents, farming, net sheets, we have all of that. Also, if you have a listing and you need open house materials, we do provide for free shoe covers, flyer stands, little shoe bins and so forth. So anything like that, feel free to reach out to us. We're here to help you. We're here to help support your business. Thank you, guys. I appreciate all your time, and we'll catch you on the next one. All right. Take care and stay safe out there. I will stay on for another 2 minutes. If anybody wants to have questions, feel free to stay on the call as well.
Hi, Jerry.
Hey, Christine.
Hey, this is Christine. Hey. So I have a quick question. Does title insurance cover the wrong square footage marketed by builder?
It does not.
Okay, gotcha.
Title insurance does not cover square footage, bed, bathroom count, and so forth. So that's not something. And again, we also don't cover like address. So if an address is, 1245, but it's actually 1246. Title insurance doesn't cover those things.
Got it. Thank you, Jerry.
Yeah, you're welcome.
Good day.
Again, guys, hey,
Jerry.
Rob. Hey.
Yes, hi, thank you. Thank you for taking my question. I have a question. I'm going to get a listing, and the owner passed away.
Okay.
One of the owners, the spouse, the wife, she's still alive, but the property is under it's on a living trust.
Got
And
it.
daughter, she's going to sell the property. What do you recommend me to do? I would like to know if they're going to pay capital gains or those things.
So can you, I left my email in the chat box. Can you email me or call me and let's look up the address? Because if it's under a trust, then we just need to see who is the trustee. And if the trustee is the person that passed away, then you need to get a copy of the trust from the seller so we can verify who is the successor trustee. And then that person will be the person that you will be working with and signing the contract with. So so connect with me afterwards so you can send me the address and then we can look it up together.
Okay, no problem. We can do that.
Yeah.
Okay, thank you so much.
That's what we want to do. We want to make sure that if it's in a trust, one, that title is under a trust, and two, who is the trustee, all right? And then we may have to request a copy of the trust.
Yeah, she's a trustee. The person that I'm talking to, she's on the trust. I saw the information.
Okay. Then
Yeah,
most likely we'll just need to get a copy of their trust to verify who's the successor if she's passed away, and then a death certificate. That's it.
Okay. Okay, then. And thank you so much. I'll talk to you later.
Okay, sounds good.
Thank you.
Well, if anybody does not have any questions, no remaining questions, then I'll go ahead and end the call here. Any other last minute questions? Okay, guys. Well, thank you again for your time. I'm going to go ahead and end the call, stop the recording.